So here you are as a donor to a charity, and you're trying to do your due diligence. You're trying to find out by looking on the charity's website and also looking on third-party, big databases online that claim to rate thousands and thousands of charities. You're looking on these websites to see, hey, what percentage of my donation is actually spent on this particular charity's programs? And you find the information and everything looks good. It checks out. It looks like 90% or 80% or more of a charity's budget is spent on programs. And you think, great, they're keeping their overhead costs reasonable. This sounds good. I'm going to make a donation. So did 80 or 90% of your donation really get spent on the charity's programs? Well, there's an accounting trick that's well known to accountants and charities, but isn't so well known to donors, called joint costs. And essentially, and while I call it an accounting trick, it actually is a perfectly it's actually perfectly within the rules. Charities are allowed to report their spending this way as long as they follow the rules. Essentially, if a charity sends out a solicitation, so in the mail or on a telemarketing call, and they might spend millions and millions of dollars on this, as long as they include a call to action and some educational materials in that solicitation, they can claim that they are quote unquote educating you. And therefore, the spending that they did on direct mail, on telemarketing calls, they can claim that that is a program. But is it really what you as the donor thought you were funding? Most of the time, based on the conversations we at Charity Watch have had with donors, that's not what they think they're funding. When they get a letter in the mail or a call or see a crowdfunding campaign conducted by a charity, saying that, hey, 80% or 90% of your donation is spent on our programs. And then when they describe the programs as, helping animals or preserving the rainforest or aiding injured veterans, you think, well, that's what my money's going to be spent on. Those are the programs. You're not really thinking as a donor that, oh, the vast majority of my donation might actually just fund more fundraising activities. So do beware of joint costs. Now here at Charity Watch, because we dig into not just the tax forms, but we also look at audited financial statements of that sometimes include multiple legal entities of a charity, and we really dig into the numbers. We actually make an adjustment. We take these joint costs out of reported program spending and reallocate them to fundraising where we believe most donors think they really belong. We do show a range of numbers, so we do show what the charity's program percentage would have been if we hadn't made that adjustment. So if you as a donor are okay with funding these types of activities and you think that a charity's direct mail and telemarketing calls are legitimate programs, you're welcome to look at that unadjusted percentage, and that will better reflect your goals. But again, most donors we speak with, they don't think that that's the programs that they're funding. So, look at our site at charitywatch.org. Check out our program percentages and our overhead percentages and our cost to raise $100 fundraising ratios, because we do take joint costs into account. There's one more thing to understand, which is that a lot of times charity tax filings are rife with errors and omissions. So we have seen countless examples of a charity not reporting joint costs on their tax form because tax forms are not audited. And then we go ahead and look at the charity's audited financial statements, and we can see that, oh, there are joint costs, and the charity just failed to report them in their tax filing. Other situations can be that sometimes a charity's audited financial statements will be consolidated. So they'll include more than one legal entity. So sometimes what we see is one legal entity is absorbing a huge amount of fundraising costs, including joint costs sometimes, and a different legal entity of the charity, like a sister entity, is claiming a higher program percentage because this other entity is absorbing their fundraising costs. But in the audit, when we look at the numbers together, we at Charity Watch can see, well, how efficiently is this charity actually operating overall once you put those figures together and eliminate for related party transactions? How efficiently is this organization really operating on the whole? That's what you really want to know. Now, because our analysis is very in-depth here at Charity Watch, it's time intensive, and that does limit the number of organizations that we can evaluate. We rate about a little over 600 large national charities. So please do check out our website, because if it's a large national organization, there's a better chance that we were able to dig into their finances. But we unfortunately can't rate all organizations. So, get a hold of a charities audit. We have a resources for donors page on our website where we give you advice about how to obtain charity tax filings, how to obtain copies of charity audits. The audit's more reliable generally, so you can look for joint costs there. Highly recommend that you do this if we don't have information on a charity and you're looking to give a larger donation. If you're looking to give a donation of several $1,000s in particular, you're going to want to do a little extra due diligence. In the tax form, provided that the reporting is correct, which it isn't always, it would be Part 9, Statement of Functional Expenses, and joint costs are generally reported on line 26. Total joint costs are in column A, and the joint costs allocated to program are in column B. So what you can do is you can say, okay, of the $1 million program expenses, they're saying 600,000 is joint costs. Well, you'd want to maybe subtract that out and reallocate it to fundraising if you agree with our process, which is that those are really fundraising costs, or that donors really believe those are fundraising costs. So that's something that you can do on your own by looking at the tax form 990 of a charity, or by obtaining their audited financial statements. I know that all this accounting stuff is not super intuitive to everyone, but I hope that conceptually, at least, I've given you something to think about. You really can't always rely on charities to report about themselves, their finances, in a way that you necessarily as a donor either agree with, or that it actually aligns with your goals. Accounting rules may allow certain types of reporting that make a charity's program percentage appear much higher than it really is. And then secondly, third-party websites that rely on a lot of crowdsourcing from the charities themselves, or that rely on a lot of automation, and as a result are able to rate thousands and thousands of charities. Well, how much time do you think they're spending digging into that information if they're rating thousands and thousands and thousands of charities? Unfortunately, it would be almost impossible, if not totally impossible, for any rater to have the resources that would be needed to actually do a very in-depth analysis of thousands and thousands of charities' finances every year. I can't even imagine the amount of resources that would require if you're spending many, many hours per charity. So just keep that in mind before donating. This was a video about joint costs, charities reporting of joint costs. My name is Lori Styron. I am the Executive Director of Charity Watch. We're a national charity rating and watchdog organization founded in 1992 and based here in Chicago, Illinois. I hope this was helpful. Thanks, everyone.